Welcome, curious minds, to another deep dive. Today we're plunging into a story that really embodies a huge dichotomy you sometimes see in the public markets. Ascent Solar Technologies?
Yeah, it's quite the case study.
Exactly. This is a company with, truly groundbreaking, even NASA-validated technology. Yet, historically, it's been kind of teetering on this, precarious financial edge.
Right on the brink, multiple times.
So the big question we're tackling is its recent, really extraordinary surge a true ascent towards commercial viability, or is it maybe just a speculative mirage? Like basically a venture capital-style bet in the public markets that could just as easily, well, burn out.
That's the core tension, definitely.
We're taking a look at Ascent Solar Technologies, ticker ASTI, and our analysis date is June 26, 2025. On this very day, the market saw an absolutely, extraordinary surge in ASTI stock.
It was wild.
Shares soared over 104% to $2.36 in early trading. They even hit an intraday high of $3.24. Some reports were even noting increases, as high as 148% to 172%.
Huge numbers.
So we'll be using that $2.36 price as a key reference point, while definitely acknowledging the extreme volatility that characterized the day.
Absolutely. And our mission today is to really understand the catalysts for this dramatic surge. We need to dissect the company's core business model, evaluate its management, its financial health, and, conduct a rigorous assessment of its intrinsic value.
Right.
We want to figure out its investment profile within, let's say, a value investing framework, or maybe see if it even fits that framework at all.
Okay, so here's how we'll structure this deep dive for you. First, we'll unpack the company's core, that's its business, the management team, and crucially, its financials.
The numbers, yeah.
Then we'll pivot to market sentiment, the ownership structure, and the critical risks involved before we try to arrive at a comprehensive conclusion. Sound good?
Sounds like a plan. Let's get into it.
Chapter 1. Business analysis.
So what exactly is Ascent Solar Technologies? What's their unique selling point? You mentioned it's not quite like other solar companies. Exactly. That's the key thing to grasp right away. Their primary value proposition isn't about putting the cheapest solar panels on your roof.
Yep.
It's about delivering power where traditional panels just cannot go. So Ascent Solar designs, manufactures, and sells these proprietary, high-performance, flexible, thin-film photovoltaic PV solutions.
Flexible thin film.
And they've made a really strategic pivot away from the commoditized terrestrial solar market. That ship has sailed for small players. Instead, they target these high-value niche sectors.
Like what?
Things where lightweight and flexibility are absolutely paramount. Think aerospace, defense, and maybe even specialized applications like agrivoltaic.
Right, putting panels over crops or something.
Sort of, yeah. But the big focus is aerospace and defense. So you should think of them less as a conventional energy company and more like a high-tech aerospace component supplier, especially now with their NASA partnership kind of solidifying that identity.
That reframing really is crucial. So what's the core technology that underpins this potential, and how does it actually translate into products?
Okay, so their core tech is copper indium gallium selenide, or CIGS. It's a type of thin film solar cell, and they manufacture it on a flexible polyamide substrate. That flexibility is, it's key.
Polyamide, like Captain Tape, that kind of stuff.
Exactly, that kind of high-performance plastic. They also have this patented process called monolithic integration, or MI.
MI, got it.
This enhances durability, allows for custom voltage outputs, and importantly, it reduces a lot of the common points of failure you see in traditional rigid solar arrays.
Ah, okay. More reliable then.
Potentially, yes, especially under stress. And these unique characteristics allow them to tailor products for very specific markets. For space-grade PV, they offer rollable array blankets.
Rollable? Wow.
Yeah, like for the Novi Space Satellite Constellation launch planned for 2026 and their Titan product line. For UAVs and defense, their lightweight panels can integrate directly into drone wings, maybe extending flight times by as much as 50%.
50%? That's huge for drones.
It is. And yes, even agrivoltaics, integrating solar with agriculture, though that seems less of a focus right now.
It sounds like they're playing in a very specialized sandbox then. How big is this company in the grand scheme of things? Are we talking like a major player?
Oh, not at all. Ascent Solar is a microcap company. Really tiny. Before this recent surge, its market cap was only about $2.9 million.
Wow, that's small.
It really is. Often less than, say, a single successful local restaurant chain. They operate just one 4.5 to 5 megawatt facility in Thornton, Colorado.
One facility.
Just one. Now, contrast that with First Solar, right? The dominant U.S. thin film player. They have a manufacturing capacity exceeding 9 gigawatts. That's 9,000 megawatts.
Okay, so orders of magnitude difference.
Exactly. This vast difference tells you Ascent Solar isn't even trying to capture the mass market. It's positioned itself as a specialized boutique manufacturer, maybe a leading U.S. innovator in featherweight, flexible, and durable CIGS thin film. That's their niche.
So if they're not competing on price per watt in the usual sense, what's their true selling point for these niche markets? What makes someone choose them?
Okay, it really boils down to 3 pillars, delivering power where traditional solar panels just cannot work. First, a superior power-to-weight ratio.
Lighter is better, especially for space.
Absolutely critical for mass-constrained applications like satellites and drones. Every gram you save can drastically cut launch costs. We're talking potentially millions per kilogram saved. They've touted arrays generating over a watt per gram.
That sounds impressive. What's second?
Second is flexibility and durability. Their panels are rollable, they can conform to curved surfaces, and they can apparently withstand impacts and keep generating power. That's crucial for reliability in harsh environments like space or, on the battlefield.
Makes sense. And third?
Third, and this is arguably the most important one right now, flight heritage and validation. Their technology isn't just theory, it's actually proven in space.
Ah, the NASA connection again.
Yes. It achieved NASA Technology Readiness Level 9, TRL-9. That's the highest level of tech maturity through missions like Momentous Vigoride 6 and Missy-10.
TRL-9. It's okay.
This highest level of validation is frankly a game changer for risk-averse aerospace and defense clients. It significantly de-risks their technology in a way lab tests just can't.
That's a powerful differentiator, definitely. Now, let's zoom out a bit. Are there larger industry tides that could actually lift Ascent Solar's boat or maybe, sink it? What are the market trends and the competitive forces here?
Right, good question. Ascent Solar operates at the intersection of 2 key industries, really. First is that niche thin film solar market. It's small, maybe 5–7% of the total solar market, but it's projected to grow at a healthy clip, maybe 8% to 15% compound annual growth rate through 2035.
Okay, decent growth in the niche.
Yeah, specifically for applications where thin film's unique properties are needed. The CIGS subsegment, their specific tech, is forecast around 10% growth. Second, and this is really ASTI's primary target, is the booming space economy.
The new space race, kind of.
Exactly. It's projected to expand to maybe $1.8 trillion by 2035, driven partly by the US FCC licensing over 100,000 new satellites. That creates just unprecedented demand for space-based power systems.
Wow, 100,000 satellites. That's a lot of potential customers.
It is, but the competitive landscape is intense. While First Solar isn't really a direct competitor for ASTI's specific niche.
Right, they do utility scale.
Exactly. But there are formidable future competitors. Think Swift Solar. They're developing high-efficiency perovskite tandem solar cells that could be a real threat. And Empower Technology, they're commercializing flexible silicon cells and have already snagged a major contract for over 200 Airbus satellites.
Ooh, okay, so real competition in the same space, literally.
Literally. This highlights what you could call a binary outcome risk for Ascent Solar. Their entire existence is basically predicated on the superiority of their flexible CIGS technology. If a competitor develops something lighter, more efficient, or cheaper,
their advantage disappears.
Exactly. ASTI's value proposition could become obsolete pretty quickly. An investment here is really a bet that their specific technological moat will stay superior and defensible long enough to scale.
So what is their moat then? You mentioned the tech, but what are the barriers keeping others out?
Well, their moat is actually quite robust, specifically for their niche. First, there's the intellectual property, a pretty comprehensive patent portfolio built over 40 years of R&D.
40 years, wow.
Yeah, the tech has deep roots. Second, technological complexity. Successfully manufacturing these high-efficiency, durable, flexible CIGS cells at scale. It's incredibly difficult.
So hard to copy.
Very hard. And third, back to that flight heritage at TRL-9.
Yeah.
It's extremely difficult and time-consuming for any new entrant to replicate that level of space-proven validation.
Okay, IP, complexity, and flight proof. What about brand or cost?
Well, brand-wise, they're not a household name, obviously, but within their niche, aerospace and defense, they have strong recognition thanks to collaborations with NASA, JAXA, Novi Space, Momentous.
Right, the key players know them.
Exactly, cost advantages. Well, they currently have zero economies of scale at the unit level. Their cost advantage is entirely application specific. The ultra-lightweight nature of their panels drastically reduces total mission cost for space applications due to launch savings.
So it makes the whole mission cheaper, even if the panel itself isn't the cheapest.
Precisely. Finally, their domestic manufacturing base in Thornton, Colorado. Given the geopolitical focus on secure domestic supply chains, especially for defense, having a U.S. factory is a significant strategic asset for winning government contracts.
Chapter 2, Management Evaluation. Okay, let's pivot now and turn our attention to the leadership team.
Yeah.
Who's actually at the helm here, and what's their story, especially given, the company's past financial struggles?
Right. The executive team's makeup at Ascent Solar, it really suggests a deliberate strategic choice. They seem focused on financial discipline and, crucially, commercialization.
Getting product out the door and sold.
Exactly. The average tenure for the management team is just over 2 years. That points to a recent and pretty comprehensive overhaul.
A new team for a new phase.
Seems like it. Paul Worley, he's been CEO since May 2023, but he was the CFO before that. His background is in corporate turnarounds, restructurings, places like GE Capital, Deloitte.
Finance guy in charge?
Promoting him from CFO to CEO is a pretty powerful signal, right? It suggests the company's strategic priority has shifted decisively from just inventing tech to actually monetizing it and trying to achieve financial stability.
Makes sense. Who else is key?
There's Bobby Galati, the COO since 2010. He provides that crucial long-term institutional knowledge, especially on the engineering and manufacturing side, which is vital if they want to scale up. And Jin Zhou, the CFO since April 2023, has extensive public accounting experience, think PwC, Deloitte. That should mean rigorous financial oversight.
Okay, so a mix of finance, turnaround, and long-term tech knowledge.
Right, and the company's history, as you said, it's fraught with financial crises, multiple NASDAQ-Q delisting notices, value-destroying reverse stock splits. It's been rough. So this current management team, you could really call them a special situations team. They seem assembled specifically to execute a turnaround.
What does that involve?
Securing new financing, which they've done, sharpening their business focus onto these high-margin niches, not trying to boil the ocean, and achieving critical third-party validation, most notably that June 2025 agreement with NASA we keep mentioning.
So the NASA deal wasn't just random luck, it was part of the plan.
It certainly fits the turnaround narrative perfectly.
How transparent is this new leadership team with the public, especially given the company's, checkered past?
Well, from what we can see, Ascent Solar appears to adhere to standard public company transparency norms. They issue press releases regularly. Their investor relations website has corporate governance documents, code of ethics, whistleblower policy, that kind of thing.
Standard stuff.
Yeah. And CEO Paul Worley has been actively engaging in public communications, interviews, podcasts. That's generally a positive sign, showing a willingness to be transparent and communicate their vision.
Okay, let's talk about capital allocation then. This is always critical, especially for a turnaround. Given their history, how has the company historically used its money? And how might that be changing now?
Historically, any capital Ascent Solar raised seems to have been immediately consumed by R&D and just significant operating losses.
Just keeping the lights on, basically?
Pretty much. It's really been a story of survival, not strategic growth. And that led directly to this massive accumulated deficit and, frankly, severe shareholder dilution over the years.
Dilution, meaning more shares issued, so each existing share is worth less.
Exactly. They have deeply negative return on invested capital, or ROIC. We're talking figures like negative 143% to negative 213%. It means they've systematically destroyed value for every dollar invested in the business historically.
Ouch.
Yeah, and there's absolutely no history of share buybacks or dividends. Capital has flowed exclusively from investors to the company, mainly through these dilutive offerings.
So what's the new plan for capital?
Well, under this new leadership, the stated strategy is to allocate capital towards commercialization and scaling up their manufacturing capabilities. The goal is to be ready to fulfill potential large-scale orders from the space and defense sectors, triggered by things like the NASA validation.
So spend money to make money, finally.
That's the hope, but it still requires getting those big orders first.
Chapter 3, Financial Analysis. All right, let's get to the hard numbers now. This sounds like where the story gets pretty stark. What do Ascent Solar's financial statements actually tell us about the company's health?
Stark is a good word. A rigorous look reveals, well, a perilous financial history. Their financials are, frankly, a catastrophe across the board, historically speaking.
Okay, lay it on us.
First, market cap. As we said, nano cap around $2.9 million before the news. It swelled to over $4.1 million post-surge, but that's still tiny, and that valuation is entirely based on future potential, zero on current standing.
Got it. What about revenue?
Revenue history. It's a story of decline and stagnation. I mean, virtually non-existent recently. For the trailing 12 months, TTM revenue was a mere $42,000.
The 42,000, not million.
Thousand with a T, down from $1.2 million back in 2022. This just illustrates the chronic condition they've been in.
Wow, okay. What about profits? Or rather, losses?
Losses is right. Their profit margins are catastrophically negative. It's hard to even comprehend. Imagine selling a product for $1, but it costs you, say, $14 just in materials and labor to make it.
It's not sustainable.
Not even close. Their gross margin for the TTM was negative 1,311%. Operating margin, negative 15,039%. Net profit margin, negative 15,987%.
15,000% negative margin.
It means they lose enormous amounts of money on every single thing they manage to sell, even before you count R&D, admin, sales costs.
Well, where does the cash come from to keep operating?
That leads directly to their free cash flow. It's consistently and significantly negative. TTM free cash flow is negative $8.78 million.
Burning almost $9 million a year with barely any revenue.
Exactly.
Yeah.
This persistent cash burn is precisely why they've repeatedly needed to turn to the capital markets for funding, mostly through those dilutive stock offerings we mentioned. Without a clear path to positive cash flow, their survival depends entirely on continuously raising external capital.
So it sounds like a company that's been losing money consistently for a long time. Does that mean it's constantly on the verge of collapse? How stable is it really?
Well, there's no earnings consistency except that it's consistently negative.
But-
Long-standing, significant net losses. TTM earnings per share was negative $3.59.
Oof.
Now, their debt-to-equity ratio is 0.74. That might look okay in isolation, right? Less debt than equity, but it's built on a very, very fragile equity base. That equity base was actually negative in the recent past.
Meaning liabilities exceeded assets.
Correct. Total debt is around $1.9 million against total equity of about $2.58 million. Their current ratio, which measures short-term liquidity, is around 1.25 to 1.3. That's pretty thin, likely only positive because of recent cash infusions from stock sales.
Cutting it close.
Very close. And dividends. Non-existent, obviously. They are in absolutely no financial position to even consider paying one. The financial statements tell a story of a company that has had multiple near-death experiences. Their current positive equity is temporary, funded entirely by new investors buying stock.
Okay. Given all these, frankly, terrible numbers, what's Ascent Solar actually worth? How on earth do you value a company like this that seems so completely detached from traditional metrics?
Yeah, this is where it gets really interesting and, frankly, very difficult from a traditional value investing perspective. The valuation of Ascent Solar is, right now, completely detached from its historical or current financial performance.
So it's all story, all future.
It is fundamentally a bet on a future narrative. If we try to look at relative valuation, metrics like price to earnings, PE, not applicable, earnings are negative. Price to sales, PS, it was an extremely high 81.97 before the surge and became even more astronomical afterward.
80 times sales, when
Right.
sales are only $42,000.
Exactly. It indicates the market is pricing in absolutely enormous future growth. Just for context, First Solar, a profitable leader, trades around 3.3 times sales.
Big difference.
Huge. So trying to value ASTI with discounted cash flow, a DCF model, it's like trying to hit a moving target in the dark while blindfolded.
Okay, got the picture.
You can build a model, sure, but the inputs are pure speculation because there's no reliable history of positive cash flow to project from, and the future path is incredibly uncertain. Any number we give you, like a hypothetical range of maybe $0.50 to $4.50 per share, is purely speculative.
50 cents to 450, that's a massive range.
It reflects the uncertainty.
Yeah.
And getting even into that range depends on incredibly optimistic assumptions, like projecting revenue growth of over 100% per year for the next 5 years straight.
Wow, hypergrowth.
Hypergrowth. And critically, using a very, very high discount rate, maybe 25% to 35% to account for the company's extreme risk profile.
Higher discount rate means future cash is worth less today, right?
Oh, exactly. Reflects the high chance you might get nothing. This high risk is also flagged by something called the Altman Z-score. For ASTI, it's around a netical 115.2.
Is that bad?
Extremely bad. Put simply, the Altman Z-score tries to predict bankruptcy. A score that low suggests an exceptionally high probability of financial distress, potentially leading to bankruptcy within the next couple of years if things don't change drastically.
Okay, so the bottom line on valuation.
The stock's value resides not in its assets or earnings power today, but entirely in the perceived probability of its future success. And that probability was dramatically repriced upwards by the NASA news. An investor here isn't buying a business in the traditional sense. They are buying a high-risk option, like a lottery ticket on a future outcome.
We've just peeled back the layers of Ascent Solar's internal world, the tech, the management, the frankly scary financials. Before we look at the external forces shaping its future, like market sentiment and ownership, let's take a quick moment for a word from our team. If you're finding this deep dive valuable, and we hope you are, make sure you like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And remember, for our members, at just $4.99 a month, you get priority deep dives on specific tickers. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those.
Plus, if you're looking for a one-off deep dive on a stock we haven't covered, you can always drop a super thanks. We do take those requests seriously. Chapter 4, Market Sentiment.
Okay, we're back. So if the valuation is all about this future narrative, what was the buzz around the stock on June 26th? What was the market perception that actually drove that massive surge? Right. Well, market sentiment was, you could say, overwhelmingly bullish that day. And it was clearly driven by a single, really powerful news catalyst, that announcement of the 12-month collaborative agreement notice with NASA to develop beamed power technology.
Beamed power, like wirelessly sending power.
Potentially, yeah.
Yep.
That's a whole other fascinating area. But the key was NASA's name attached. Now, interestingly, there's a complete lack of formal coverage from major Wall Street banks. No big analyst reports, no official price targets.
So no buy or sell ratings from the big firms?
Nope. While some data aggregators might show anomalous targets, like one mentioning $60, these are almost certainly data errors or outdated figures. This absence of professional analyst coverage is really a double-edged sword.
How so?
On one hand, it means there's no institutional critical analysis, no one pouring cold water on the enthusiasm. That allows retail sentiment to drive these extreme valuations. But on the other hand, it means there's a potential future catalyst if coverage eventually does begin.
If a big bank starts covering it, that could boost the stock further.
Could. The immediate and profound impact of the NASA news itself was just palpable. Headlines were focusing on game-changing, out-of-this-world partnership. That positive narrative completely overshadowed the underlying financial weaknesses, which were often just mentioned as footnotes, if at all.
No, that makes sense. News drives the narrative. Narrative drives the price. Was this surge maybe a short squeeze, though? Were people betting against it forced to buy back?
That's a really important question to ask with surges like this. But in this case, the answer seems to be no. Short interest leading up to the surge was actually very low, around 1.5% of the public float as of late May 2025.
Only 1.5% short? That's tiny.
It is, and this low short interest is crucial evidence. It pretty much confirms that the massive price surge was not a short squeeze. A squeeze requires a high level of short interest to begin with, forcing those shorts to cover.
So what caused it then?
The enormous trading volume that day, over 44 million shares traded, compared to maybe a few 100,000 normally, combined with that low short interest, definitively indicates the price action was driven by a massive influx of new buyers reacting positively to the NASA news.
Just pure buying pressure.
Exactly. It means the rally was based purely on a sudden, dramatic shift in bullish sentiment, making the elevated price potentially quite fragile if that sentiment changes. Technically, the stock price exploded far above both its 50-day and 200-day moving averages.
Which signals?
It's a classic, strong, bullish momentum signal in the short term. And surging above the 200-day like that, especially after a long downtrend, is often seen as a potential long-term trend reversal signal. But again, based on news, not fundamentals yet.
Chapter 5. Ownership structure. All right, let's look at who actually owns this company. Does the ownership structure itself tell us anything about its risk profile or why it might be so volatile?
Oh, absolutely. The ownership structure of Ascent Solar is, well, it's the classic signature of a high-risk, high-reward story stock.
Okay, what does that look like?
First off, institutional ownership is exceptionally low. bordering on non-existent, really. Depending on the source, it's reported between 0.47% and 0.75%. That's incredibly low.
Less than 1% held by big funds.
Right. And the largest institutional holders are mostly passive index funds like Vanguard or BlackRock. This means they hold ASTI not because they actively believe in it, but because their mandate requires them to track an index that ASTI happens to be a tiny part of.
So no active managers choosing to invest.
Exactly. The near total absence of active institutional ownership from mutual funds or hedge funds that perform deep due diligence is a significant red flag. It suggests that the professional investment community historically hasn't seen the quality or stability they look for.
Okay, if institutions barely own it, who does?
Well, in stark contrast, insider ownership is significant. It ranges from maybe 0.41% for some individuals up to potentially as high as 32.96% for certain affiliated entities or long-term holders, though data here can be tricky. CEO Paul Worley himself owns about 1.84%.
So management has skin in the game.
Yes, a meaningful stake, which does align their interests with shareholders, which is good. However, recent insider trading activity has been minimal.
And a risk.
The rest is overwhelmingly held by retail investors, individuals like you and me. It's estimated that retail investors hold well over 88% of the company.
Wow. Almost 90% retail.
Yeah. And this ownership structure, highly concentrated in insiders and retail investors, directly explains the stock's extreme volatility and its high sensitivity to news-driven sentiment.
Because retail investors react more quickly to news.
Often, yes.
Yeah.
And with few large, stable institutional holders to act as an anchor for the price, it's subject to the rapid buying and selling decisions of a large, fragmented group of individual investors. It really is the classic profile of a story stock. Its price is dictated almost entirely by the prevailing narrative. If that narrative falters,
There's no institutional floor to support the price. It could drop fast.
precisely. There's no valuation bedrock based on current earnings or assets.
Chapter 6. Risk Assessment. This definitely sounds like a high-stakes play. Let's try to put a structure on all these risks and potential upsides.
Yeah.
Can we do a SWOT analysis, strengths, weaknesses, opportunities, threats?
Absolutely. A SWOT analysis is perfect here because the strategic position of Ascent Solar is really defined by this fundamental conflict between its internal strengths and weaknesses, all playing out against a backdrop of significant external opportunities and threats.
Okay, let's start with the good stuff. Strengths.
Okay, strengths. Number one has to be its proprietary technology. Unique, patented, and that flight-proven TRL-9 flexible CIGS solar with the superior power-to-weight ratio. Number two, the NASA validation.
Yeah.
A powerful third-party endorsement that de-risks the tech and opens doors. Three, it's U.S.-based manufacturing. That Colorado facility gives it a secure supply chain and a strategic advantage for government work. And four, the experienced turnaround leadership team specifically chosen to commercialize these assets.
All right, solid strengths based on the tech and validation. Now the weaknesses. I suspect this list might be longer.
Yeah. Weaknesses. First, chronic unprofitability, as we detailed. That long, ugly history of net losses and negative gross margins. Second, that feeds directly into high cash burn, which necessitates frequent dilutive external financing just to survive. Third, a significant lack of scale. That tiny 5 milliW capacity is just inadequate if they actually land orders for large satellite constellations. And fourth, customer concentration risk. The business model likely relies on winning just a few very large contracts, making them highly dependent.
Okay, unprofitable, burning cash, too small, and reliant on big wins. Got it. What about opportunities? What could go right?
Opportunities. The big one is the growing space economy, that massive addressable market for lightweight PV, driven by those tens of thousands of new satellites. Second, the favorable tariff environment being exempt from the 2025 U.S. tariffs on Chinese silicon gives them a potential cost advantage domestically. Third, potential government incentives, like the Inflation Reduction Act's 45X manufacturing production tax credits or DOE funding programs, if they can scale. And fourth, emerging technology applications, like that beamed power concept from the NASA deal, could open entirely new markets down the road.
So, huge market, helpful regulations, maybe government money, and new tech spinoffs. Okay, finally, threats. What could derail this?
Threats. First, intense and well-funded competition. We mentioned Swift Solar with perovskites, M-Power technology with flexible silicon, both targeting the same high-value niche, and potentially with better funding or newer tech. Second, financing risk is constant and existential. An inability to secure future funding when they need it could simply lead to insolvency. Game over. Third, execution risk is massive. Can they actually translate the cool lab tech into reliable, high-volume manufacturing and revenue? It's unproven. And fourth, the ever-present risk of technological obsolescence. What if perovskites, or something else entirely, emerges with dramatically better performance or lower cost?
Right, that binary risk you mentioned earlier.
Exactly. And what's really crucial to understand from this SWOT is that fundamental conflict. Ascent Solar's greatest strength, its unique validated tech, is perpetually threatened by its greatest weakness, its precarious financial position. The tech needs continuous investment to stay ahead and scale up, but the company doesn't generate that cash internally.
So it's a race.
It's a high-stakes race against time. They absolutely must leverage their current technological lead and this NASA momentum to secure real revenue-generating contracts before the cash runs out, or a competitor leapfrogs their technology.
How do broader macroeconomic factors, like, say, inflation or rising interest rates, affect a company like this that seems so reliant on future potential rather than current earnings?
Yeah, they're definitely impacted. Higher interest rates are a direct headwind for what you might call jam tomorrow stocks like ASTI,
Why is that?
because the value is based on highly uncertain cash flows way out in the future. A higher risk-free interest rate increases the discount rate investors use in their valuation models. That mechanically lowers the present value of those distant, uncertain cash flows, makes the stock look less attractive today.
Okay, higher rates hurt future growth stocks. What about inflation?
Inflation is also tough. It increases operating costs, labor, materials, energy. For a company already suffering these deeply negative margins, inflation just exacerbates their cash burn. It shortens their financial runway, making them need to go back to the markets for more cash sooner, likely on worse terms.
So macro headwinds add pressure. Now, what about those specific U.S. tariffs on imported solar modules you mentioned? You said it was an opportunity, but is it entirely a good thing or is there a catch?
Generally, the 2025 U.S. tariffs on solar modules coming from China and Southeast Asia are a net positive for Ascent Solar, on paper.
Because it makes imports more expensive.
Right. By raising the cost of competing imported silicon panels, these tariffs make ASTI's domestically produced non-silicon products look more competitive on price within the U.S. market. That could be a powerful tailwind if they can get production costs under control.
But there's a but.
There's always a but. This advantage is entirely dependent on the continuation of these specific trade policies, a future change in administration, a shift in geopolitical strategy. These tariffs could be reduced or eliminated. Poof, advantage gone.
Political risk.
Exactly. And the same goes for valuable manufacturing incentives from things like the Inflation Reduction Act. Those could also be modified or repealed. Critically, these potential tailwinds don't solve the fundamental business challenges. The company still needs to prove it can produce a commercially viable product at scale, market it effectively, and win contracts against those tough competitors. The tailwinds are useless if the ship itself has no engine, or if the engine keeps breaking down.
Chapter 7. Conclusion. This has been a really fascinating journey into Ascent Solar Technologies. So much potential, so much risk. Can you synthesize all of our findings for us? What's the big picture takeaway here?
Yeah, I think the analysis really reveals a company of just extreme contrasts. It's a story of genuinely cutting-edge, space-validated technology pitted against this long, difficult history of profound financial failure. That dramatic stock surge on June 26th, it was arguably a rational market reaction to a single powerful piece of validating news from NASA, but it absolutely does not erase the fundamental, deeply embedded risks inherent in the business itself.
Okay, so let's recap the bull and bear arguments clearly. What's the core bull case?
Okay, the bull case, the reason to be optimistic, rests primarily on these points. First, validated differentiated technology. It's unique, it's patented, it has that TRL9 NASA rating, flexible CIGS with superior power to weight. That's real. Second, powerful NASA validation. That agreement is a massive third-party endorsement. It de-risks the tech in customers' eyes and gives them a crucial foothold in the space market, maybe even beamed power. Third, large and growing addressable market. Space, defense, UAVs. These are potentially huge markets with high growth and high barriers to entry, which fits their specialized tech. Fourth, favorable geopolitical and regulatory tailwinds. Being a U.S. manufacturer, benefiting from tariffs on imports, potential IRA incentives, these help. And fifth, experienced turnaround management. They seem to have assembled a team specifically tasked with commercializing this asset, finally.
Okay, that's the hopeful story. Now the counter arguments.
Yeah.
The bear case.
Right. The bear case is equally, if not more, compelling based on history. First, disastrous financial history. We can't ignore the negligible revenue, the massive historical losses, the negative cash flow, and the severe shareholder dilution. It's ugly. Second, extreme financial and dilution risk. It's still a microcap burning cash. Its survival depends entirely on accessing capital markets. The bankruptcy risk, flagged by that Altman Z-score, is objectively high. More dilution seems almost inevitable. Third, massive execution and scaling risk. They have yet to prove they can transition from R&D and tiny production runs to reliable, high-volume manufacturing that meets customer specs and timelines. That's a huge hurdle. Fourth, intense and advancing competition. Those well-funded competitors like Swift Solar and Empower are real threats, plus the constant risk of technological obsolescence from things like perovskites. And fifth, purely speculative valuation. The stock price is basically untethered from current fundamentals. It's primarily owned by retail and insiders, making it highly volatile and dependent on sentiment staying positive.
So when we talk about its valuation, that wild range you mentioned, 50 cents to $4.50, what's the real takeaway for our listener? Is the current price of $2.36 a reasonable, too high, too low?
Yeah. As we stressed, any precise intrinsic valuation here is highly, highly speculative. Trying to pin a single number on it with a DCF is more an academic exercise than a practical guide right now.
Right. Hitting a target in the dark.
Exactly. Our hypothetical DCF model, even built on those aggressive assumptions, hypergrowth, very high, 25-35% discount rate reflecting extreme risk, produced that wide theoretical value range of 30.50 cents to $4.50 per share.
A ninefold difference between low and high end.
It really just illustrates the vast uncertainty. It's not a prediction. The fact that the post-search price of $2.36 sits within that speculative range suggests the market is pricing in a significant probability of success, but certainly not guaranteeing a best-case scenario outcome. It reflects hope tempered by risk.
So boiling it all down, what's the ultimate takeaway for our listener here? How should they think about ASTI?
Ultimately, I think an investment in Ascent Solar Technologies today is best understood as a venture capital style bet, but one placed in the public markets.
High risk, high reward, early stage, but publicly traded.
Precisely. It is not an investment in a stable, predictable business with established earnings. It is a high-risk, arguably binary outcome proposition. It's a bet on a specific technology and on this new management team's ability to execute an incredibly difficult corporate turnaround against the clock.
Binary meaning it either works spectacularly or goes bust.
Largely, yes. The potential rewards, if the company succeeds in becoming a key supplier to the burgeoning space economy, could be substantial. However, the risks, including financial collapse, competitive obsolescence, simple execution failure, are equally profound. A total loss of invested capital is a very, very real possibility here.
So who should consider this then?
This stock is therefore suitable only for investors with the absolute highest risk tolerance, folks who can afford to lose their entire investment. They need a multi-year time horizon to let the story play out, and crucially, a deep understanding of its purely speculative nature. This is not for the faint of heart, or for money you can't afford to lose.
As I reflect on this deep dive, what truly stands out to me is just this incredible tension, right, between the sheer brilliance, the elegance of Ascent Solar's technology, validated by NASA no less, and the brutal, stark reality of its financial history and current condition.
It's a stark contrast.
Yeah. So, as Ascent Solar aims for the stars, quite literally the question remains, can this truly brilliant technology finally escape the gravitational pull of its financial past? Or is it maybe destined to burn out before it ever really reaches orbit? What are your final thoughts on that balance, and what should our listeners really mull over after hearing all this?
My final thought is pretty simple, really. The market, especially after the NASA news, has clearly priced in a significant amount of hope. But hope doesn't build factories or ship products. Success from here requires relentless, near-flawless execution by management and almost certainly access to massive amounts of additional capital down the line. It's an absolutely fascinating story to watch, but from an investment standpoint, it's one that demands extreme caution and eyes wide open to the very real risks.
Excellent summary. We hope this deep dive into Ascent Solar Technologies gave you some valuable insights and things to consider. If you enjoyed it, please make sure you like this video and subscribe to the Stock Analytics AI YouTube channel.
And remember, for our members at just $4.99 a month, you get priority deep dives on the tickers that matter most to you. Plus, you get that exclusive early access to our full coverage of all the S&P 500 stocks, which we're rolling out over the next few months.
And if you just want a one-off deep dive on a specific stock we haven't covered yet, just drop us super thanks. We do look at those requests. And finally, please remember our crucial disclaimer.
This analysis was generated by an AI system. It's intended for educational and informational purposes only and should absolutely not be considered financial advice or recommendation to buy or sell any security. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.